Listen, the reason most people never build real wealth has nothing to do with how much they earn or how smart they are. It's because they're chasing. They're chasing trends. They're chasing hot stocks. They're chasing whatever made someone else rich last year. And chasing is the opposite of building. Chasing is reactive. Building is intentional. And if you want to actually accumulate wealth that lasts, you need to stop reacting to what's popular and start focusing on what actually compounds. I've watched this pattern repeat for decades. A new investment trend emerges. Everyone piles in. The early people make money. The media covers it. More people pile in. And then it ends. And the people who showed up late lose everything. This happened with dot-com stocks. It happened with housing before 2008. It happened with SPACs. It happened with NFTs. It'll happen again with whatever's hot next year. The asset changes. The pattern doesn't. And here's what bothers me. People know this. They've seen it happen. They've maybe even lost money in a previous trend, but they do it again anyway, because they're afraid of missing out, because they see other people making money and they think, this time is different. This time I'll get in early. This time I'll get out before it crashes. And they're wrong. Because timing trends is not a wealth building strategy. It's gambling, and the house always wins when you're gambling. Real wealth, the kind that lasts, the kind that survives market cycles and gets passed down to the next generation, is not built by chasing trends. It's built by owning assets that produce income, appreciate over time, and compound without requiring you to be smart about timing. That's it. That's the entire game. Everything else is noise. Now, I'm not saying you can't make money trading trends. You can. I've done it. But that's trading. That's not wealth building. Trading is active income. It requires constant attention, constant decisions, constant risk. Wealth building is passive accumulation. It happens while you sleep. It happens whether you're paying attention or not. And the assets that do that are not the ones getting hyped on social media. So let me break down exactly what actually builds wealth. Not theory, not what sounds good, what actually works over decades. Because I've been doing this long enough to know the difference between what works and what sells. The first asset class that builds real wealth is cash flowing real estate. And I need to be specific here. I'm not talking about flipping houses. I'm not talking about Airbnb arbitrage. I'm not talking about hoping property values go up. I'm talking about buying properties that generate positive cash flow every single month after all expenses. Here's why this works. Real estate gives you three things simultaneously: cash flow, appreciation, and leverage. The cash flow pays you every month. The appreciation builds equity over time. And the leverage, if used correctly, amplifies both. That combination is what creates wealth. Because while you're collecting rent, the property is also going up in value, and you're paying down the mortgage with someone else's money. That's compounding on multiple levels. But most people screw this up. They buy properties in hot markets because everyone's talking about them. They overpay. They underestimate expenses. They assume appreciation will bail them out. And then when the market turns or a tenant stops paying or a major repair comes up, they're underwater. They're forced to sell at a loss or hold a property that's costing them money every month. That's not wealth building. That's speculation. The difference is simple. If you're buying real estate hoping it goes up in value, you're speculating. If you're buying real estate because the numbers work today, right now, with current rents and current expenses, you're investing. Speculation requires you to be right about the future. Investment works regardless of what the future holds. I buy properties that make money on day one, and if they appreciate, great. If they don't, I don't care, because I'm making money either way. Now, here's what people don't want to hear. Good cash flowing real estate is boring. It's not in the hottest neighborhood. It's not sexy. It's not something you brag about at dinner parties. It's a duplex in a working class area that produces 8% cash on cash returns. It's a small apartment building in a secondary market that's been stable for 20 years. It's unglamorous, but it works. And working is better than exciting. The second asset class that builds wealth is dividend-paying stocks. And again, I need to be specific. I'm not talking about growth stocks. I'm not talking about companies with great stories. I'm talking about established, boring, profitable companies that pay consistent dividends and have been doing it for decades. Here's why dividends matter. When you own a stock, you're making a bet that someone will pay you more for it in the future than you paid today. That's capital appreciation. And maybe that happens, maybe it doesn't. But when you own a dividend stock, you're getting paid regardless of what the stock price does. The company sends you cash every quarter. And if you reinvest those dividends, you're buying more shares, which generate more dividends, which you reinvest. That's compounding. I've held dividend stocks that have gone up. I've held dividend stocks that have gone down. I've held dividend stocks that have gone nowhere for years. And it doesn't matter because the whole time I'm collecting dividends, and those dividends are buying more shares. And over time, that snowball becomes unstoppable. But you have to be patient, and most people aren't. Most people want the stock that's going to double in a year. They want the next Amazon, the next Tesla. And maybe they find it, maybe they get lucky, but that's not repeatable. That's not a system. That's a lottery ticket. And lottery tickets don't build wealth. Consistent compounding builds wealth. The companies I focus on are the ones nobody talks about. Utilities, consumer staples, industrial companies, businesses that have been around for 50 years and will be around for 50 more. Businesses that make products people need regardless of what's happening in the economy. Businesses that generate cash and return it to shareholders. That's not exciting, but it works. And here's the thing about dividend stocks. They're self-correcting. When the price drops, the yield goes up, which makes it more attractive, which brings in buyers, which supports the price. So you get natural downside protection that growth stocks don't have. And in a market crash, that protection matters. Because while growth stocks are getting cut in half, dividend stocks are holding up better. Not because they're immune to crashes, but because the income stream acts as a floor. The third asset class that builds wealth is your own business. And I don't mean a side hustle. I don't mean some passive income scheme. I mean an actual business that solves a real problem for real customers and generates real profit. Here's why owning a business is different from everything else. When you own stocks, you own a piece of someone else's business. When you own real estate, you're landlording. But when you own your own business, you control everything. You control the revenue, you control the expenses, you control the growth. And if you build it correctly, you create an asset that produces income and has value independent of you. Most people think owning a business is risky, and it is. But so is depending entirely on a job you don't control. So is hoping your stock portfolio goes up. The question isn't whether something is risky. The question is whether the risk is worth the reward. And if you build a business that generates consistent profit, that risk pays off. Now, I'm not saying quit your job and start a business tomorrow. I'm saying if you're serious about building wealth, at some point you need to own something that you control. Because you can't get rich working for someone else. You can make good money, you can have a comfortable life, but real wealth, the kind that changes your family's trajectory, comes from ownership. And the easiest path to ownership is building a business. But here's the part people miss. The business doesn't have to be revolutionary. It doesn't have to be the next unicorn. It just has to make money. Boring businesses make money. Service businesses make money. Local businesses make money. And if you can build something that generates 50,000 or 100,000 or 200,000 a year in profit, and you do that for 10 or 20 years, you've built real wealth. Because that profit can be reinvested or paid out or used to buy other assets. That's how compounding works at the business level. The fourth asset class is yourself, your skills, your expertise, your ability to earn. And this is the one people ignore because it doesn't feel like an asset, but it is. It's the most important asset you have. Everything I just talked about requires capital. Real estate requires capital. Stocks require capital. Businesses require capital. And where does that capital come from? It comes from your ability to earn. So if you're not investing in increasing your earning power, you're limiting everything else. This doesn't mean go back to school. This doesn't mean get another degree. This means get better at what you do. Get skills that are valuable in the market. Get skills that people will pay for. And then leverage those skills to earn more. Because the difference between earning $75,000 a year and earning $150,000 a year is not just the lifestyle. It's the investment capacity. It's how fast you can build the other assets. I've seen people focus so much on optimizing their investments that they ignore the fact that they're under-earning. They're trying to squeeze an extra 0.5% of return out of their portfolio while leaving $100,000 a year on the table in income. That's backwards. Your income is your biggest wealth-building tool. And if you're not maximizing it, you're not serious about building wealth. Now, here's where people mess this up. They think investing in themselves means consuming. They think it means buying courses or going to seminars or getting certifications that don't actually increase their market value. That's not investing. That's spending. Investing in yourself means acquiring skills that someone will pay you more for, skills that translate directly to higher income, and then using that higher income to buy the other assets. So those are the 4 asset classes that actually build wealth. Real estate that cash flows, dividend stocks that compound, businesses you control, and your own earning power. Everything else is a distraction. Everything else is a trend, and trends don't last. Now let me tell you what doesn't build wealth. Crypto might make you money. It might not. But it's not a wealth-building asset. It doesn't produce income. It doesn't compound. It just sits there and you hope someone pays you more for it later. That's speculation. NFTs, same thing. Meme stocks, same thing. SPACs, same thing. These are all just different versions of the same game. Get in early, hope it goes up, try to get out before it crashes. And maybe you win. But that's not building wealth. That's gambling. I'm not saying don't speculate. I'm saying don't confuse speculation with wealth building. If you want to take 5 or 10% of your portfolio and gamble on trends, fine. That's your entertainment budget. But your wealth building capital, the money that actually matters, needs to go into assets that work regardless of whether you're smart or lucky. And here's the other thing people get wrong. They think diversification means owning a little bit of everything. Crypto, stocks, real estate, gold, commodities, private equity, whatever's being talked about. And they call that diversified. But that's not diversification. That's just owning a bunch of stuff. Real diversification is owning different asset classes that produce income in different ways and respond differently to economic conditions. If you own dividend stocks in cash-flowing real estate and a profitable business, you're diversified. Because if the stock market crashes, you still have rent coming in and business profit. If real estate drops, you still have dividends and business income. If your business has a bad year, you still have passive income from the other two. That's real diversification. That's protection. But if you own 10 different cryptocurrencies and 5 different meme stocks and 3 different NFT projects, you're not diversified. You're concentrated in speculation. And when the speculation trade ends, everything you own drops at the same time. That's not protection. That's correlation. And correlation destroys portfolios in downturns. Now let me address the objections. Because I know what you're thinking. You're thinking, Kevin, real estate is expensive. Dividend stocks are slow. Building a business is hard. And all of that is true. Building wealth is expensive, slow, and hard. That's why most people don't do it. They want the shortcut. They want the hack. They want the thing that makes them rich in a year without effort. And that doesn't exist. Every person I know who has real wealth built it the same way. Slowly, consistently, boringly. They bought assets that produced income. They reinvested that income. They waited. They didn't chase trends. They didn't get distracted. They just kept buying assets and letting them compound. And after 10 years, they were comfortable. After 20 years, they were wealthy. After 30 years, they were set for life. But here's the problem. 10 years feels like forever when you're starting. 20 years feels impossible. So people look for faster ways, and they find trends. And trends promise fast money. And they chase, and they lose, and they start over, and they chase again, and they lose again. And they waste decades chasing instead of building. And that's the real tragedy. Not that they lost money, but that they lost time. Because time is the one input you can't get back. If you're 30 years old and you start buying cash-flowing real estate and dividend stocks and building a business, by the time you're 50, you're wealthy. Guaranteed. Not maybe, guaranteed. Because those assets compound. But if you spend those 20 years chasing trends, by the time you're 50, you're starting over. And now you don't have time. Now you need the trends to work because you can't wait 20 more years. And that's when people make desperate decisions. That's when they take stupid risks. That's when they lose everything. So the question you need to ask yourself is simple. Do you want to spend the next 20 years chasing, or do you want to spend the next 20 years building? Because you're going to spend them either way. Time is going to pass regardless. The only question is what you have to show for it at the end. I know what I'd choose. I'd choose boring. I'd choose slow. I'd choose assets that work. Because I've seen both paths. I've seen people chase trends for decades and end up with nothing. And I've seen people buy boring assets and end up wealthy. And the difference isn't luck. It's not intelligence. It's not timing. It's just discipline. It's the willingness to do the thing that works instead of the thing that's exciting. Here's what happens if you ignore this. If you keep chasing trends, here's how it plays out. You'll make money on one. You'll feel like a genius. You'll tell everyone about it. You'll put more money into the next one, and you'll lose it. And you'll think, that was just bad luck. The next one will work. And you'll do it again, and you'll lose again. And at some point, you'll realize you've spent years going in circles. You're not ahead. You're maybe even behind. And the people who were buying boring assets are now financially free, and you're still chasing. That's not hypothetical. That's what happens to most people. I've watched it happen over and over. Smart people, hardworking people, people who should have built wealth, but they chased instead of building. and they have nothing to show for it. So here's what you do. You stop. You stop chasing. You stop looking for the next hot thing. You stop trying to get rich quick, and you start building. You buy one cash-flowing rental property, just one. You open a brokerage account and start buying dividend stocks every month, just a little. You start a side business, just something simple, and you do that consistently, not perfectly, just consistently. And you wait. You let the rent compound. You let the dividends compound. You let the business profit compound, and you don't touch it. You don't sell when the market drops. You don't cash out when things get tight. You just let it sit and grow. And in 10 years, you'll look at your net worth and you'll be shocked. Because you'll have actual wealth, not paper gains, not hype, real assets producing real income. And here's the best part. Once you have that foundation, once you have assets that are compounding, you can afford to speculate. You can take some of the cash flow and gamble on trends if you want. Because now it's house money. Now losing it doesn't hurt. But until you have that foundation, chasing trends is just destroying your ability to build wealth. So that's the framework. Real estate that cash flows, dividend stocks that compound, businesses you control, your own earning power. Those 4 things will make you wealthy if you give them time. Everything else is noise. Everything else is distraction. And if you can ignore the noise and focus on what works, you'll build wealth. It's not complicated. It's just hard because it requires patience. And patience is the one thing most people don't have. But you're not most people. You're here. You're listening, which means you're at least open to doing this differently. So do it differently. Stop chasing. Start building. And 20 years from now, you'll thank yourself. If this made sense, subscribe, because I'm going to keep giving you the frameworks that actually work, not the ones that sound good. And if you want to understand exactly how to evaluate these assets and avoid the traps, watch the next video. I'll see you there.